Okay, I think let's start. Hello, everyone, and welcome to Straight Talk Digital Banking. Our live today is where your software provider answers the questions your board will fire at you in the next quarter. I'm your host, Pooja Kothari, product marketer for digital engagement at SBS. And with me today, I have on the hot seat Hassan Nasser, Deputy General Manager of Digital Engagement at SBS. Welcome, Hassan.
Hello, Pooja. Thank you for hosting me. Hello, everyone.
Thank you for joining us. Over the next 30 minutes, we'll dissect over 8 boardroom pressure points. Hassan, you already have the experience of these questions, hence we put you on that hot seat today. We'll be covering the silent iteration, the onboarding choke points. We'll talk about AI. We'll talk about the regulatory landscape in Europe, and also cover the super apps market landscape in the African market. For us, the target today is to really focus on the matrix, the playbooks, and the ROI that can be quoted in the Monday morning executive meetings. So the chat is open for everyone. Please keep your questions coming as we go through the live, and we'll tackle all of the questions at the end of the live. We have 15 minutes of Q&A, so please keep the questions coming. With that, Hassan, are you ready? Should we get started?
Yes, go ahead. Let's do it.
Okay, so first question. The banking apps today, the digital banking apps, boast a 78% 90-day retention rate. Yet 1 in 5 retained customers never fund or transact. There is a silent iteration there. Which 2 activation or UX moves have proven to convert at least 60% of the newly onboarded customers into weekly active, if I'm not taking a bigger number? And what revenue lift have you seen following that?
That's so true that 1 of every 5 customers end up dormant after a few weeks from being onboarded, and really some banks did it well, like Starling Bank, for example, eliminated the gap by issuing a virtual debit card the second the KYC is completed. And customers can add it to Apple Pay or Google Pay in 30 seconds. And the result is across all their 4+ million users, there is 100+ card activation and 20% jump in months one spend compared to others. Another example is with New Bank, for example. And New Bank, what they did is a day 14 spending quiz, which is essentially gamifies the first dozen of transactions. And this allowed them to have a weekly active users hit 63% at day 120, which is double the mainstream bank norm stats. And New Bank, the good thing about it, it actually attributes 15 to 18 basis points of net interest income lift thanks to this. Okay, so if I want to summarize it from our experience as well across 30+ markets where we serve multiple banks, I think combining an instant spend plus an early insight could possibly halve the dormancy and pull forward break even on acquisition cost by roughly 4 months. And the way to do that is repeatable. So the patterns are there, which is making the first transaction friction-free, delivering personalized aha moment before week 3, and track funded and transaction weekly by day 120 as a real KPI instead of downloads or installs.
Okay. So if I understand right, New Bank and Starling Bank have really cracked that code with instant spend on day 1 and the spending DNA, the aha moment, like you said, by week 2, leading to the quiet accounts waking up, and that clearly is moving the needle for them. But all of that upside only starts after the customer clears the KYC, really, and that's where I've seen that the crowd loses out. Let's zoom in on that a little bit. Would you say that is the biggest dropout point in the entire journey? And across 30+ emerging markets, market banks that you serve, How do you see which onboarding elements are the biggest first session drop off, let's say, and what would you do to cut that if we put a challenge into half?
Yeah, the variability across markets is really different. But one thing that remain consistent is the fact that the time when a customer needs to actually upload documents or do identity verification, that is the most choke point across a KYC process that is self-service, because simply they might not be in the right place in the right time with the right documents when they are doing that, and so many of them bail out. Some stats is up to 2/3 drop off when forced to input documents or do a selfie or do something like that. So and there are two real patterns to fix it, in my opinion. One is you need to have a better ID verification or legitimation process, and this is usually where the national digital identity come into play. For example, in India with Aadhaar or in the Nordics with EID, that is possible, and that makes the ID legitimation or the ID verification process so simple and so straightforward that makes it frictionless and significantly improve or reduce the drop-off ratio in that sense. I think for one of the Nordics banks was 20% drop-off only, compared to typically 60% or 50% with the traditional ID verification or ID legitimation process. The second point or the second pattern that we see is the progressive KYC, and essentially is breaking the KYC into bite-sized chunks and limiting the amount of data you collect to a very minimal until you really need that additional level of information or that additional risk check per se. So that removes the pain point and the tedious verification and offers a more guided flow per se. And also an example of that was Santander in the UK, where they digitized the onboarding process, and they reduced the time roughly from 12 days to 2 days by deferring heavy checks until a first high-risk transaction.
Okay, understood. So we're saying that we swap the passport selfies for bank or government IDs, or break the KYC into snack-sized bites, and then this will lead to significantly boosting, the get-through first time. Could we quantify it? Could we say that it could be around 70 to 80%?
Yeah, in some stats where it was quantified, it was roughly reduced by half, which the drop-off ratio was 20% compared to 50 or 60%. So yeah, it's roughly something like that.
Okay, so once the KYC friction is removed and the completion is, let's say, doubled, that's beautiful. Now, these new customers expect day one relevance. Everybody watches Netflix, so they are thinking the Netflix for banking. But we know that the AI rulebook is really watching. So let's tackle that a little bit. Can we switch on hyper-personalized journeys and still stay inside of the EU AI Act compliance?
In my opinion, like you have to personalize as a bank today. It became something mandatory for digital world, but not only for differentiation, but it's really something that is expected by a lot of your customers. But never at the cost of compliance, because that's what bank's job is to protect people's money as part of it. And so the AI Act final text puts marketing and personalization engines in the limited risk tier if they are transparent and bias tested. And Societe Generale already run 300 plus AI and data use cases today, and that complies with the EU AI Act and keep them in the limited risk zone. So every inference carry and how they did that is by actually a few things. One, every inference carries what they call an AI provenance stamp, which is a model ID, versions, and confidence store. And they have a pre-production gate that essentially simulate outcomes across different protected classes. And any drift that is beyond this certain threshold, more than 5%, then they don't deploy it, basically. And these two are the key guardrails. Then they added one more thing around transparency in September 2024, if I remember correctly, which is when the customer gets something personalized by AI, like a tile, it shows why am I seeing this, and they have a link to opt out from that, and that adds transparency and improve customer trust. So yeah, I think there is definitely a way to personalize and be compliant at the same time.
Okay, that's clear. So we are saying that stamp every AI decision, run the bias gate, give people a, why I am seeing this, and you're still allowed to make that 500 million on personalized offers.
I mean, yeah, Societe Generale claims roughly 500 million or half a billion of value by 2026. It's bold, it's big. I like it. But it's possible.
Yeah.
So let's see how it goes. I think the key thing when it comes to compliance is to just make sure you move away from any kind of black box algorithms, making unchecked credit decisions, cohort manipulations of users, and really all the ethical practices that banks have to conduct today. The AI Act is trying to highlight those in context of this new technology, and to make sure that this is covered when you leverage this new technology for use at scale with your customers. So in that sense, I believe it makes sense.
Okay, and you've spoken about AI, and we know that any AI engine is as powerful as the data it feeds on. And when I'm talking about data, I also want to tap into PSD3 a little bit, because it's going to really blow that data wide open. So let's pivot a little bit there and understand how PSD3 Open Finance with or under PSD3 Open Finance, how can a bank protect its monetizable customer data assets while meeting those mandatory API publishing rules, and how can banks leverage it for themselves? What does the playbook look like there?
Well, what's important to highlight that PSD3, while it pushes banks into open finance, it does not mandate banks to or force them to give away the crown jewels of their data or their services for free. The strategy is to comply with the mandatory minimum, then monetize value added on data on top of that. So in practice, it's a two-tier API approach, and tier one is really publish the required APIs by now PSD2 or PSD3, PSR1 when it comes, with the security and only the data fields mandated, and no extra that competitors could exploit unless it's part of your go-to-market strategy. Then develop a premium APIs or services that use deeper insights, which can be offered to fintech or partners for a fee. And many banks in Europe already eye this model and do that already. For example, BBVA in Spain publishes the mandatory APIs, but they run a paid API market for premium endpoints like cash flow classification or payroll verification. And in 2024, that marketplace turned its first 7 million ARR while playing within the PSD2, PSD3 rules. And I think in that sense, you just treat your APIs as a product, just like any other banking product. You think, which markets do I want to target, and how do I want to package this product for this fintechs or partners and deliver that? So it's really going back to product management one-on-one and be able to think about it from that perspective and deliver to that rather than anything else. One more thing that I think is relevant in the PSD3, that when when the open banking initiatives is that when data or APIs are open, they level the playing field, which means these APIs are available for everyone, including the banks themselves. And the bank themselves can consume other banks' APIs, and they can act as an AISP themselves. So that is quite important, because in that sense, banks can not only protect or package their own APIs, but they can enlarge their data by gathering other data from other banks in that sense. And from that perspective, that allows for even more advanced use cases of targeting customers that are banking with different banks, and allowing them to actually move or to understand the market better and create better offers that are more relevant to the market.
Okay, that makes sense. So if I summarize quickly, free APIs for the basics, invoice the fintechs for the clever stuff like what DBVA has done.
Yes.
And that leads you to this best path. But DBVA's example, they've also recently expanded into the Open API deal from 3,000 to 11,000 ChatGPT enterprise licenses in May. In your opinion, what is your comment on their strategy, and what is the learning for others here? What is the advantage?
Yeah, I mean that's interesting. I don't know exactly how they will use these APIs. They might use it internally, or these licenses, or they might use it to actually create some kind of premium APIs or use it within their products itself, and that can be interesting. So it's really interesting to see some banks just leaping into the AI space and doing that. Nonetheless, what's really important and fundamental is robust governance around the API, about the API management, around throttling, around the data and watermarking the data, about ensuring that even data as it flows out, it's tracked and ensure that it is not misused. And the result is a bank that can remain GDPR compliant, that also meets PSD2, PSD3 regulations and beyond, but it still preserves capabilities to monetize and package into new offerings when they need to. And yeah, AI plays directly into that.
Okay, very clear. We've touched upon two major regulations in the EU, but regulations are obviously not over yet. We all remember the specific circle mark on the calendar on every EU diary, the 17th January 2025, when DORA was enforced. My question is, which three artifacts and which three metrics and two artifacts convince directly the directors that they will survive the supervisory review? What is your comment there?
Yeah, that's very specific. Well, I don't think the message is really directors or don't need a 200-page resilience Bible, but they want proof that they'll pass the DORA inspection. And DORA already answers around what are the key metrics and the artifacts. For example, the critical incident frequency, and to target roughly less than one per quarter. The mean time to recover, and this is inspired by all the agile and the lean movement, which is essentially less than 30 minutes to recover any tier 1 system. The third party resilience score, which is 100% of critical vendors tested and exit run books signed. And the artifacts as well, essentially, that could be generated beyond the key KPIs or the key metrics, are the board approved operational resilience plan mapped to impact tolerances, as well as the results from the last disaster recovery or threat-led penetration tests with penetration tests with evidence of all the findings that are closed. And this is, banks are used to do these things. This is not new. And I've seen in the headlines somewhere that some banks already sailed through mock exams, like I think ING or Santander.
Yeah.
So it's I believe DORA will in its spirit, it encapsulates a lot of the other standards that happened over multiple years, and they were distributed across multiple ISO standards, and bring it together and harmonize that. And in some sorts level the playing field, but at the same time sometimes increase the barriers for other. But I feel it's pretty important harmonization towards the future, and it sets the scene for what banks should really care about from a resiliency standpoint.
Okay. So the three major KPIs that you mentioned: critical incident frequency, mean time to recover, and the third-party resilience score is really to look at. And then the two artifacts that you mentioned, that ticks the box for resilience. Let's talk a little bit about future-proofing these rails themselves. When we are looking at real time, that is today, versus the CBDCs that are coming. For any bank that's eyeing cross-border real-time corridors, which architectural decisions today avoid the costly rework with the payments today, and then the CBDCs arriving? How to avoid that?
Yeah, I mean, real-time payment corridors are growing really fast across the board, everywhere across the globe. You have many examples of that, from Buna, for example, or Pan-African PAPS rail, and the instant payment in the EU, of course. But the key, I think, architectural decision to future-proof is to follow one principle, is really to decouple message formats from the payment processing and ensure essentially that you have a modular architecture that could be reusable. And that's that rather than done in reality. And many banks are at very different levels depending on what they have in their data centers today or running for them. For example, I think APSA in South Africa, if I am correct, they were able to convert every payment into an ISO 222 JSON. And that allowed them to connect multiple rails relatively easily with reusing the same messaging, like Swift, Buna, and Digital Rand, which is a CDBC on a CDBC sandbox that was added with roughly 80% reusability. So, and why ISO 222? Because we believe that essentially regulators will not go and reinvent new messaging structure. They will use what is becoming the new norm and the standard. So once CBDC becomes there, I do believe this would be the standard messaging behind it. Yeah, I mean, the rails should be currency agnostic to allow you to automatically do that. And one important point on, I think, resiliency is these instant payments rails, one of the key points of them is to have instancy 24/7, which means the resiliency needs to be active deployment with everything requires to support a 24/7 instant payment infrastructure. So that allows bank to avoid a last minute change and investment and a longer investment because the pipes, the formats, and the operational resilience is already compatible when CBDCs eventually arrive.
Got it. Okay. Hassan, you already told us about how to monetize. I think we should also tackle the distribution aspect, which is the next battlefield. The question is how to distribute those premium services at scale when we're tackling the African market. Nothing spreads faster than the super apps, and I'm bringing the super apps in the conversation now. Looking at the African market, OPay logs 10 plus million daily active users. M-Pesa logs 34 million users plus only in Kenya. As super apps reshape everyday payments, what strategy has delivered the highest ROI for banks in your opinion? Is it the orchestrating their own mini app marketplaces or embedding their services inside an exciting super app, or both? What architectural decision would make these paths viable for the banks, let's say in a timeline of 12 months?
Yeah, you don't make it easy, do you? So the answer is really depends who you are, because the best strategy, in my opinion, is whether you choose one or the other, is to fish where the fish are. in banks term, go where the customers are. So if you own or you have a large direct distribution network and have a large customer base or a direct distribution channel, and you have a large daily active customers, then yes, a super app can make sense for you. Just for a reference, when we talk about, for example, Safaricom's M-Pesa super app, it keeps 40% of daily active users in-house for more than 5 minutes per session. At
Huge.
that scale, that is really huge. So if you don't have something like that, it's a hard play to achieve, and it takes a large investment and a sustained one with high capex and slow scale. An example of that was, I think, GT Bank in Ghana. They built at a point of time their own Habari Pay or Habari Super App. I might be not accurate on the name, but 3 years later, they were less than 1 million monthly active users. Okay, so it's a risk, and that's why when you go for the other play, which is an embedded play, sometimes where the fish already are or where the customers already are, it really makes sense sometimes to distribute your products through these wallets or through these third parties. And one good example of that, I think, is NCBA that plugged savings and loans into M-Pesa, and they roughly generate 1 trillion Kenyan shillings, which is 7 to 7.7 billion dollars dispersed in 2024. And as per their investment deck, it's roughly at a higher than 30% on return of equity, with a virtually zero cost of customer acquisition. And you can literally go live in months with APIs in this. So I think saying all of that, my gut feel is embedding banking services and existing super apps have delivered higher ROI rather than building a standalone super app from scratch.
Absolutely. You spoke about the investment and you gave the example of NCBA, the loan example as well. I wanted to ask, and that's the final piece really of this journey that we are trying to map. Inside these journeys, what lending plays outperforming the traditional channels? And can we address the embedded lending inside the non-bank journeys? What are the insights that you might be able to share with us? Where has it delivered, for example, the biggest revenue surprise so far?
So NCBA is a great example because it's huge, it's big, and it has quite a good return.
Yeah.
So also I would say NCBA is a success story in that sense. But also retail buy now pay later still is one of the how to say the surprises of how much it can generate revenue at volumes. Because Stripe ran an A/B test for 150,000 checkouts, showed and that showed that merchant offering BNPL saw a 27% uplift in revenue, mostly from net new sales. And that directly translates into banking because one example of that was when BNP Paribas Alma widget went live in Decathlon France. The average basket size jumped by 11% within 6 months. So why it works? Because credit appears exactly when the customer's buying impulse peaks, and the approval is in less than 2 seconds, and the merchant pays the fee for a short-term loan, and for banks, it's virtually zero customer acquisition, near zero. And the traffic arrived from the retailer. So if you're hunting or the bank is hunting for a new fee of pools, embed credit where the impulse happens, and the volumes will surprise the CFO.
That's these are pretty good insights, and that sort of helps me summarize and map that route for everybody who's listening in. Going from activation to onboarding to personalizing to proving the resilience, monetizing the data, being ready for CBDCs, future proofing it, distributing and lending in the end. Like you rightly said, in the end, all of these micro bridges keep the momentum high and make the transition, or let's say each transition, feel like it's deliberate and that it's not abrupt. That is how the big win comes in. um, there are a lot of questions that are coming in, and it's time for the Q&A, but I'd like to give you some time to conclude on this, Hassan. Any last insights, any key takeaways for everyone?
I think the one thing I want to add that we are a software company, so we build products for solutions for almost everything we have discussed today at SBS or specifically within the digital banking suite. So anything from digital acquisition for deposit, credit, retail, or business, direct or embedded, with experience and design or API only, with AI personalization across literally the whole engagement lifecycle, we are ready to help banks go to the next level. And whether banks have a point problem or solution, and they are like a point problem or solution, or they are looking for the whole platform, we can serve all of these situations. So I'll be happy if you connect with us, and we are ready to help you and see how we can solve problems or deliver value together.
Absolutely. You're right, Hassan. Please do not hesitate to drop into the comments or contact us directly, and we'd be happy to help. I'll take the first question, and this is really interesting one, Hassan. Have How have peer banks used real-time AI to cut social channel frauds while keeping the false positive ratios and sideboard limits? And what is the cost?
Uh,
Very
so,
specific.
yeah, again, I mean, there are. If I want to just to repeat the question, essentially it's about the real time AI versus the social channel fraud,
Yes.
and I do believe in the US or North America, roughly between WhatsApp and Facebook now accounts 35% of fraud losses. And another example, Lloyd Banks in the UK actually built in a behavioral analytics engine, and in the first 9 months, it stopped roughly £4 million across 1,900 customers, and they were able to reduce 60% of the social engineering losses for the first year. So what I'm trying to highlight that it makes sense to invest in AI to reduce fraud, because the cost of fraud is too high for banks um, uh, to actually be able to sustain that. And the key pattern is make sure that you are able to not only invest in AI in a high level, but to go to the minute level of what does it mean to have a social engineered fraud. And this means time is very limited because it's milliseconds rather than minutes. It means be able to think multimodality across device telemetry, keystroke, and different network data, and to be able to triage high-risk transactions very quickly with explainability. Because without explainability, it's a big issue as well.
Makes total sense. Okay, I'm gonna take another question really quickly. Separate topic. It's around SME and consumer credit. The question reads: SME and consumer credits are converging. which alternative data shift moved approval speed and loss rates the most when looking at the European context?
Well, I think my, I, I don't have the numbers at hand. My guess would be the open banking data would be the most relevant alternative data source to reduce credit decisions. And in 2024 and 2025, and it's becoming more the norm. And the reason behind that is you can make much more accurate decisions based on high accuracy data directly across one or multiple bank accounts in a pretty straightforward way, which allows you to reduce the time to do a credit decision, sometimes to seconds, but in SME context to hours or less. So that is I think the most important alternative data in that context for credit decisioning.
Okay, so are we saying that this shift is relying on the credit bureau scores to leveraging the real transaction data, and is the single biggest, let's say, for single biggest driver for faster, smarter lending?
Credit bureaus can do it. However, banks can directly also leverage the open banking data. So there is two ways to be leveraged. Either you embed it within the credit bureau. I think Experian does that already in the UK, and they add open banking data as an additional score, or they embed it in the score. And then you have other providers that already aggregate data from like Algon or others, and essentially give you credit insights in order to make better decisions on the credit that you do, whether for retail or SME. So banks can go either way, depends on where they are within their life cycle, what they have pre-integrated already. And remember, this can be one additional data point and not the only data point.
Perfect. Understood. Okay. I will take one last question before we close. Another different topic. Which specific data governance practice has enabled a measurable uplift in cross-sell without harming the NPS or triggering any privacy compliance?
Well, I think in general, if I was to say to choose one, it is the field level customer controlled consent stored in an immutable ledger is probably one of the most important governance practices leveraged today, whether it is for GDPR or whether it is in the context of open banking. It's a regulatory proof that essentially says I have an active consent, and it works to a minute level. It's very precise and it's clear. And the NPS holds because or rises because customers feel that they are in control. The biggest challenge there is to do it in a good experience and not to kill the experience while trying to do the governance well. So that's the real challenge in the implementation of stuff like that.
Okay. So on a high level, if we see there are two major points that I see in this, which is one is data-driven growth and the other one is customer trust. That is the most important aspect here.
That's so true. Yeah, that's a good insight.
Absolutely. Okay, perfect. I think we've reached the end of our live. We've covered a couple of questions. We're still expecting more questions. So keep them coming in the comments and we'd be very happy to respond to you. Or reach out to us directly, Hassan or myself, and we'd be very happy to help you out. Thank you, Hassan, so much for taking the time and providing all of these insights. And we'll see you soon, probably for the next hot seat.
Thank you, everyone.
Thanks,
And thank you,
everyone.
Pooja, for having me. Have a good day, everyone, and a good rest of the week.
Thank you.